What we see happening right now isn't showing up clearly in any single data point. If you look at inflation alone, it doesn't look broken. It's still showing up. If you look at the labor market alone, it's still stable. Growth expectations, yeah, they've slowed down a little bit, but they haven't collapsed completely. So, by their self individually, nothing too extreme is going on. But when you line everything up side by side, a very specific pattern is starting to emerge. So start with inflation, not with where it's at, but where it's coming from. So we just got PPI data, producer price index, and the recent producer price data, this is wholesale inflation data, it came in much hotter than expected. So wholesale prices rose 0.7% in a single month. That's more than double expectations, pushing the annual rate up to 3.4%. That's the highest level in a year. Great. Services inflation is still climbing. Core measures, so that strips out food and energy and trade, that's now risen for 10 consecutive months. And that's before oil fully feeds through the system. So wait, there's more. But because oil hasn't hit the data yet, it's already hit the system. Oil is back around $100 per barrel. Gasoline prices are at their highest levels we've seen since the last inflation shock back in 2022. And more importantly, energy infrastructure itself is now being targeted. It's the target everybody's watching. So there's been strikes on the world's largest gas field. That's not very good. Damage to Qatar's LNG export hub, cutting capacity by about 17% for potentially years this will go on. So there's also disruptions across Saudi and other refining systems. So this evidence we're looking at is evidence of a supply shock right in our faces. And supply shocks don't usually stay contained to energy markets. We've talked about this before. You see it show up in transportation costs, goods costs. They move into services, often with a delay, which is exactly where inflation has been proving stubborn. We've been watching stubborn, sticky service inflation data. We're not ready for it. Now, let's turn and look at the labor market. So this is jobless claims, and they came in at 205,000. That's lower than expected. It's still near historical lows. Normally, this would signal strength, but you also see continuing claims. Those are ticking higher, and more importantly, claims are a lagging indicator. They don't tell you where the economy is going in the future. Rather, these jobless claims, and this is why a lot of people kind of disregard the data when it comes out, it just tells you where it's been. So you don't really see a shock in these numbers until we're already in a shocking position in the economy. So then let's look at something else. Next, we're going to look at the bond market. So the bond market, on the other hand, this is forward looking, and it's starting to send a very, very different signal. So these are short-term yields. These are the 2-year treasury yield. So when the 2-year treasury yield goes higher, the 2-year treasury goes down. So the stock price, if you think about it like that, of the 2-year treasury goes down. When the yield, let's just call it the dividend because we all watch stocks here, the dividend goes up, the stock price goes down. Think about bonds like that. And right now, short-term yields are rising faster than that of longer-term treasuries, which this is the 10-year treasury yield right here. And when that happens, this creates what's called a bear flattening curve. It's a very specific pattern, and it usually shows up when markets expect a few things to occur. So tighter monetary policy. Tighter monetary policy sounds a lot like rate hikes being priced in. Rising inflation pressure, tariffs, this energy price crisis going on, slowing growth in the economy, all at the same time it's going on. So that combination has a name, and it's not a comfortable one. We've talked about it before. Comment down below if you know what I'm talking about. But what makes this setup more unusual is how close it is to a very specific time in history, this very specific historical moment. So the last time oil has moved above $100 per barrel and short-term yields pushed above the Fed's policy rate, the federal funds effective rate, and the yield curve flattened this aggressively was back in 2008. That was the subprime mortgage collapse. All the risky loans fell apart and the economy just went through it. Roughly 4 to 5 months later after this happened, the system broke because the system couldn't absorb everything happening all at once. And then boom, recession. And Powell, he's already acknowledged the position they're in over there at the Fed. They're dealing with this economy that's gone through not only a pandemic shock, not only a tariff shock, but add on top of that layered cake, an energy shock. All stacked on top of each other. And critically, inflation hasn't fully come down. It's been a problem for years. I think they're above target for 5 years or so now. Core inflation, core services inflation, that's still stuck, which means right now the Fed has very little room to move lower unless something happens like some black swan event like the labor market cracking and go back to jobless claims where they tell us not where we're going but where we are. When we see a sudden spike in those jobless claims, people getting laid off and filing for unemployment, that could be something that forces the Fed's hand and forces them to cut rates despite inflation being where it's at. But they've already described policy as sitting close to neutral. We've been talking about that on the channel for quite a while now. And with all of the circumstances right now as where they stand, that's not a position you can comfortably cut rates in. But waiting only works if conditions stabilize, and right now they're not. Geopolitics is extending the timeline. Markets are now assigning only about a 5% chance that this probability that the Iran conflict ends in the near term. So it's going down. People are starting to assume that it's going to last longer. Meanwhile, the Strait of Hormuz, which normally carries 20 million barrels of oil per day, that's still remaining partially constrained. They're trying to get it reopened, but everybody's thinking it's going to take a lot longer than everybody's expecting. So even these small disruptions at that scale affect not only energy, but it also affects trade flows. So then the WTO, they're already adjusting expectations. They see global trade growth slowing. They see global GDP forecasts drifting lower. They also see inflation expectations rising. So it's like we're getting slapped in the face by the Fed once all this starts fulfilling itself. And economists are now saying that oil doesn't need to go to these extreme levels for it to mean anything, to have impacts on everything. The average estimate for triggering a recession probability above 50% sits at around $138 per barrel. We're around 100 right now, so that's not, that's definitely higher, but it's not like miles away, and especially with this conflict going on. But just as important as the price is the duration, how long this takes, and everybody's estimating that it's going to take longer. On average, sustained pressure for about 14 weeks is enough to change outcomes. So the setup right now isn't about this one specific event we got. There's all of this overlap just stacked on top of each other like a cake. And it's like the little commercial in the middle of the night where they're selling something for $19.99, and to kind of sweeten up the deal a little bit, they're like, and wait, there's more. But when fewer and fewer things can go right at the same time, that is where things could get pretty dirty. So we'll keep on watching, everybody. Nothing's really changed. We'll just keep on watching together, and I'll report it as it comes. So y'all have a good one. Thank you for being here. Thank you for hanging out, and onward.